Hi friends, today in this video I am going to explain you about monetary policy and how RBI Reserve Bank of India controls monetary policy. In this video I am going to explain you one by one, first of all, what is the meaning of the monetary policy and objectives of monetary policy, why RBI needs to control monetary policy, and what are the tools for the monetary policy controlling. So, first and foremost, what do you mean by the monetary policy? Monetary policy is the process by which monetary authority of the country, what is the monetary authority of the country? That is central bank of the country. That is, for our central bank is Reserve Bank of India. So the controls, what did this control? Supply of money and also target the rate of interest. The main purpose for this is promoting economic growth and stability. Besides that, it will also protects the ensured price stability and target inflation rate and interest rate, and to bring the general trust in the currency about the country's economy. Again, I'm going to tell you, the Reserve Bank of India is vested with the total responsibility for conducting the monetary policy. This is what exactly the monetary policy. This monetary policy provides insight into how optimal monetary policy will be applying to the country's economy. Right. After having stated this, let me move on to the what are the main objectives of the monetary policy of India. The first and foremost objective is growth and stability. Right. See, the purpose, the main is to ensure rapid growth, rapid economic growth, and to also ensure price stability in the country. This is the most important objective of monetary policy because it influences the economic growth by controlling real interest rate and its resultant impact on the investment pattern. So, the RBI always opts for the cheap or easy credit policy to reducing the interest rates. In turn, it will also protect the price stability in the country. So, faster economic growth is always possible if the monetary policy succeeds in maintaining income and price stability. That is the first and foremost objective is rapid economic growth and price stability. The second one is regulation, supervision, and development of financial stability. So the RBI is regulate and supervise and development of the all the banks in the country which are existing as of today. So the main most of the what money should play only the role of medium of exchange and not more than that. So therefore the monetary policies should regulate the supply of money and supervise all the banks, and the change in money supply creates monetary disequilibrium. So the monetary policy has to regulate the supply of money and neutralize the effect of money expansion. However, this objective is always criticized on the ground that the money supply is kept constant, then it would be difficult to attain the price stability. So ultimately, regulate the banks in case of money supply and supervision the all the banks as far as the price stability is concerned, and development of financial stability. So that it will be good for all the industries which are establishing in our country. Right. Having said that, it will also promote the priority sector. Right. So what happens in this contest is it will promote the many developing countries like India suffer from disequilibrium and balance of payment. So RBI through its monetary policy tries to maintain equilibrium and promotes the priority sector like agriculture sector and industrial sector, and the BOP it will also maintain the equilibrium in the balance of payments. So what will happen here is balance of payment surplus and balance of payment deficit. So excess money supply in the domestic economy will be main problem for the Indian economy. Even lower supply will also be the problem for the Indian economy. So what it will promote the priority sector and regulate and assist balance of payments equilibrium. Then generation of employment. The concept of full employment was much discussed in Keynes' publication, just that general theory of employment in 1936. But it refers to the absence of involuntary unemployment. In simple words, full employment stand for situation in which everybody who wants job gets jobs. That is what full employment called. However, it doesn't mean that there is a zero employment. In that sense, full employment is never full. Monetary policy, how it will be useful for achieving the full employment. If the monetary policies uh, and credit supply can be encouraged, it could help in creating more jobs in different sectors of the economy. Then external stability. So what will happen? Exchange rate stability and external stability. So main is exchange rate is the price of home currency expressed in terms of foreign currency. If this exchange rate is very volatile, what will happen? It will leading to the frequent ups and downs in the exchange rate. So the international community might lose the confidence on our economy. What monetary policy will do in this context is monetary policy aims at maintaining the relative stability in the exchange rate. So basically, the RBI by altering foreign exchange reserves tries to influence the demand for foreign exchange and tries to maintain the exchange rate stability. This is what we call external stability. Then encouraging savings and investments. So in sometimes a monetary policy will follow uh, uh, or will follow different qualitative and quantitative measures, so that it will be very fruitful for the individuals as well as the industries to encourage savings and investments. And regulation of non-banking financial institutions will also be the another objective for this monetary policy. Not only that, it supports the equal income distribution. So in the most of the monetary policy can help and play supplementary role in attaining the economic equality. Monetary policy can make special provisions for the neglect supply as agriculture, small scale industries, village industries, to provide them with cheaper credit for longer term. So this will be improve fruitful for those sectors which are going to be emerging in the country. So monetary policy can help reducing the economic qualities and among different sections of the society. These are the in nutshell about objectives of the monetary policy. First, rapid growth and stability, regulation, supervision, development of financial stability, and promoting priority sector like agriculture, generation of full employment, external and exchange rate stability, encouraging savings and investments, and regulation of non-banking financial institutions. Having said that, let me move on to the what are the monetary policy decisions will be taken, how it affects the Indian rupee, and how it affects the different loans, and what the percentage they have to follow different rates of interest, and it will also be the affect the Indian currency, and what are the main implications by taking monetary policy decisions. So optimal monetary policy will always provide good quality of employment and good quality of standard living of the individual as well as the country. Right. Now, why RBI needs to control monetary policy? The main thing and main aspect of this is see, initially what we used to follow for trading and other things is barter system we used to follow. Means if you give some product, I will give you another product, but by the time there is no money involved in various aspects. So but the barter system had many problems, so people are switching to the money system after some time. So whenever their money system is involved, financial intermediaries came into the picture. Who are the financial intermediaries? The middlemen who help to circulate the flow of money from households to the business firms. So whenever there is a middleman's uh, came into the picture, there is a most problem for the exploitation of their individuals as far as the money is concerned. So who are the financial intermediaries here? There are two types of financial intermediaries: banking institutions and non-banking financial institutions. What it will be doing, whenever there is a some not having regulating body, so there is a much exploitation of the individuals as and when they require loans. So what RBI will do, RBI will controls all banks and some non-banking financial institutions also. The main aim is to control the money supply, and thereby, in turn, it will also fight for the inflation and deflation. That is the RBI needs to control monetary policy for that purpose. So, what is the inflation and what is the deflation? I would like to explain now. The inflation, right, increasing in the prices of the essential commodities, basically, virtually, and normally it is a bad for any economy. If they go on increasing the prices, what will happen? The common man is not in a position to purchase the products. So it will lead to the poverty and it will lead to the unemployment and many aspects will. So to control the inflation rate, that is the first one. Then deflation. What do you mean by deflation? It means decreasing the prices of the essential commodities. Means basically many people think that it will be good for the economy because we are getting products with cheaper rate. What is the bad for the economy as far as the deflation is concerned? People think that is it not the good whenever we get the product with cheaper price? Yes, it is not at all good for the economy because many businesses have some fixed cost of the production, some minimum light bill, phone bill, staff salary, office rent. If prices keep on falling, what will happen? The the businessman, the industrialist will suffer losses. Whenever he has suffered losses, he has no motivation to expand his business. Whenever he doesn't want to expand his business, he has to cut down the production cost. Whenever their production cost is reduced, the firing of some of the employees because staff salary they are not in a position to pay. Whenever firing the some of the employees, the new jobs are not created. Whenever new jobs are not created, the unemployment will grow up, and it will turn in turn it leads to the social unrest. So basically, now you understood that deflation is not good for the economy. It will also be the bad for the economy. If prices of everything fall, what will happen? The collection of taxes will reduce. The government has less money to spend on welfare schemes, education, healthcare, social infrastructure, and remove the poverty. And what will happen? It will in turn it leads to the increase in poverty. At the same time, it will also leads to the diseases and crime in the country. So both inflation and deflation both are not good for the economy. When so keeping these things in a view, RBI needs to control the monetary policy. Monetary policy is mainly concerned with interest rates, money supply, inflation, and deflation. Having said that, now the most important point I would like to mention here is what are the tools which we are that the RBI is using to control the monetary policy. First is quantitative measures. It is always depend on the percentages and quantitatively measured quantitative tools which are using for controlling the monetary policy. And qualitative measures, quantitative measures, open market operations, bank rate, variations in reserve ratios like CRR, SLR, cash reserve ratio, and statutory liquidity ratio. Whereas qualitative measures, credit rationing, change in lending margin, moral suasion, and direct control and direct action. So I will explain you one by one. See, RBI implements monetary policy using two tools, that is a quantitative and qualitative. So policy, it is the total policy made by the central bank and to control the money supply in the economy, and at the same time it will also fight for both inflation and deflation aspects. Right. First thing, the quantitative measures of the monetary policy, that is a open market operations, bank rate, CRR, and SLR. Now, first, open market operations. What does it mean? It refers to purchase and sale of short-term, long-term securities by the RBI in the open market. Whenever the money supply is more or shortage, then open market operations will be the tool which is implementing by the RBI. So it will the shortage or excess of money in the money market to influence the term and structure of interest rate and stabilize the market for government securities. Here different securities are there. So what RBI will do, sometimes it will buy and sometimes it will sell. When it will buy, so now RBI sells securities in open market. Who will purchase? Commercial banks and public buy it. RBI sells it and public buy it. So what the money supply gets transferred from the commercial banks to the RBI. What will happen? Excess money supply will reduce. Whenever the RBI sells securities to the commercial banks and public, they are going to purchase it. Whenever they are going to purchase it, that will what will happen? It controls inflation. Excess money supply will be reduced. Having sometimes RBI buys securities from commercial banks in open market. Whenever the commercial banks sell it and get back the money they had invested in them, thereby increasing the existing money supply. So, what will happen? Sometimes shortage of money supply will be erased. At that time, RBI buys securities from commercial banks in the open market. Commercial banks sell it and get back the money they had invested in them, thereby increasing the existing money supply. So, it controls recession. The shortage of money supply will be totally reduced. Then, bank rate. The second one is a bank rate. It is also known as discount rate. The minimum rate at which RBI provides loans to the commercial banks. Why it will be doing? Commercial RBI will provide loans and bank will pay the interest. Funds are provided either through lending directly or discounting buying money market instruments like commercial bills and treasury bills. This is the one of the tools which controls the monetary policy. Whenever they wants to increase bank rate, whenever the RBI has to decrease the bank rate, it will a sole authority. Depend on the shortage and excess money supply in the market, it will do the bank rate. Bank rate is the another tool which we can use for control the monetary policy. And sometimes bank rate increases, cost of borrowing commercial banks increases, rises. Then fall in the credit volume to the banks and reduction in money supply. As of now, the current bank rate of RBI is 6.7% interest is paying by the banks to the RBI whenever it is taking the loan. Then see, some other things are also there. The bank rate is also interest rate charged by the country's central bank or loans and advances to the country control money supply in the economy and the banking sector. It is normally typically virtually it is done on the basis quarterly basis to control the inflation and stabilize the country's exchange rate. See, this is the fluctuated rates triggers ripple effect as it impacts every sector of the country's economy. At present, bank rate is 6.75%. So, what is repo rate? Whenever the banks have any shortage of funds, they can borrow it from the central bank. See, repo rate is the rate which our banks borrow currency from the central bank. What will happen? It will also just like bank rate. Bank rate is a long term and repo rate is a not normally short term. Whenever there is a shortage of funds, the banks will borrow from the central bank, that is the Reserve Bank of India. So a reduction in the repo rate will help banks to get money at cheaper rate. When the repo rate increases, borrowing from the central bank becomes more expensive. So, in order to increase the liquidity in the market, the central bank can do it. So, the present repo rate is 6.5%. Then reverse repo rate. So, sometimes what will happen? The banks keep some surplus funds with the Reserve Bank. While repo rate is the rate at which banks borrow from the central bank, in similar at the same time, banks keep some amount with the Reserve Bank and it will provide some interest rate by the RBI, that is known as reverse repo rate. It's mostly done when there is a surplus liquidity in the market by the central bank. The present reverse repo rate is 3.35%. And Just I would like to mention what are the difference between repo rate and reverse repo rate. Repo rate, RBI charges when funds borrowed by banks. Reverse repo rate, commercial bank charges when funds borrowed by RBI from the commercial banks. So it have to pay high interest rate. Banks are offered high gains, and economic system is indexed with the. But it controls the inflation. Repo rate is controls the inflation, whereas whereas it controls the reverse repo rate controls money supply in the market. It helps deal with the deficiency of funds. It helps deal with the liquidity of funds. So this is the main differences between repo rate and reverse repo rate. Now go on to the CRR, cash reserve ratio. What do you mean by that? This is mean the amount of cash that banks have to keep with the RBI, like liquid cash and gold. The RBI banks have to keep with the RBI. So this is the this is the standard one, because every bank has to keep some amount with the RBI, that is known as the. See, what is the interest rate? The ratio is basically to secure solvency of the bank and to drain out the excess money from the bank. So basically the main purpose of CRR is it is the to secure solvency of the bank. Banks should not get any problem of inadequate funds in their banks. So they have to keep some amount with the RBI. For that, RBI has to pay something, some interest rate, that is known as the cash reserve ratio. Then statutory liquidity ratio. Right. Here, this is the amount of commercial bank needs to maintain in the form of cash or gold and approved securities before providing credit to its customers. The basically it means the every bank has to keep some amount with them to maintain as and when required. If any individual asks the money, they are in a position to provide it. The present SLR rate is 18%. And qualitative measures, see, direct action, direct control, or moral persuasion or moral suasion, credit rationing, change in lending margin, legislation, publicity. I will go one by one here. First, direct action means the central bank may take direct action against any commercial bank if they are going to violate the rules, orders, suggestions, or advice of the central bank. This is the punishment is very severe for the commercial bank, because it issues directives to commercial banks which guide their lending policy. And the central bank can also impose action against the bank that don't adhere to its directives. Then for moral persuasion. So what exactly it means that by moral pressure, it may prohibit or dissuade uh, commercial banks to deal in speculative business. The central bank uses its influence to persuade all commercial banks to follow its policies. That is, this include advise the bank to restrict trade flow during inflation or be liberal with lending during deflation. That is a moral persuasion. And credit rationing, that can control the credit. The central bank limits the amount of credit available to the commercial banks in some sectors. This can help control inflation and prevent speculative activities. And change in lending margin. See, higher margin will always requires means that a commercial bank need to keep more collateral for loan. Similarly, it reduces their lending capacity. A lower margin, what will happen? Requirement means that commercial banks need to keep less collateral, which increase their lending capacity. Changing the lending margin will also be the another qualitative measure of RBI to control the monetary policy. Having said that, let me go for the legislation. Central bank may also adopt necessary legislation for expanding and contracting credit money in the market. And publicity. It will make so many campaigns in the newspapers, magazines, and journals, and it will describe the poor economic conditions of the country, suggesting commercial banks and other financial to control credit either by expansion or contraction. These are the qualitative measures. Again, I'm going to tell you direct action can take, moral persuasion can also take, credit rationing and credit control can also be taken by the RBI, and changing lending margin, provide legislation, and make awareness among the public as far as the publicity is concerned. See, these are the different qualitative measures. Thank you. Thank you for watching. Thank you for staying with me. Thank you for your support and thank you for your encouragement. Thank you, Vananda.